Hello everyone, my name is Nate Crosby from Crosby Advisory Group. A couple of our listeners from our podcast asked if I could talk briefly about what type of investment account to open up if you are brand new to investing, you've never started, you don't have an investment account, what type of an account would be right for you? And that's a great question. If you are new to investing, a lot of times it seems overwhelming. And that feeling of overwhelm leads to the worst thing that could possibly happen, and that is to do nothing. When we look at the return or growth within our investment accounts, there are essentially three components to that. We have what we put into it, we have the actual return that we're getting from our investments, and then we have the time that those investments can sit in there and grow and do their thing. And the time component is the biggest factor, right? That's the biggest factor. And that's the factor that we really can't control. If we're older, I can't go back and say, hey, let's go back in time so I can start over and have an additional 20 years of investing time in my time horizon in my account. So the time to act is now. There's an old Chinese proverb that says the best time to plant a shade tree was 20 years ago. The second best time is today. So let's get started. If we are new to investing, we don't have an investment account, and we're trying to figure out what type of investment account we should open up, there's one question that you should ask, and that is, when do I plan on needing this money? That's huge because that answer will tell you what type of an investment account to open. If I might need this money in 5 years, in 10 years to buy a house or start a business, then I want to have access to that money. I want to have access to the whole account value without any penalties from the IRS or the tax code. That type of account is called a non-qualified account. And a non-qualified investment account is not a IRA, it's not a retirement account. It's just what I consider to be the Wild West of investing. And that is because that account has a lot of pros that go into it. Number one, there's no minimum or maximum that I have to put into that account. The account value is accessible to me at any point in time. It's wide open as far as how I can be invested in that. I could be as conservative or aggressive as I want to be. I can take advantage of what's called tax loss harvesting, which means that under the current tax code, I can actually use losses within the account to offset any capital gains that I have. So it becomes fairly efficient for tax reporting purposes. And the great thing about it is it's not pigeonholed for anything. So it's not like a 529 account or a college savings account. I could use it to pay for education. I could use it to buy a house. I could use it to start a business, anything that I want. And it's also a great account if I'm looking to create passive income. I can receive the dividends and interest from this investment account if I want to supplement my income. If there's a con about the account, it is because I have 100% access to it at all times, it is taxable. So if I buy a share of Apple for $179 and I sell it later for $200 a share, I'm going to be taxed on that growth portion. So just be careful if I'm operating this account or if you're operating this account, that you're not selling too much when you don't need to sell, because you could be creating some taxable events for yourself. So we just discussed a non-qualified account is good for a time period prior to retirement. I'm going to access it in the next 5-10 years, and it's going to be prior to retirement age. Let's say, nope, Nate, this money is 100% going to be earmarked for retirement. I'm going to make sure that my retirement is in good order and in good health, so I'm going to start saving for retirement now. Awesome. An IRA, an individual retirement account, is a good option for that. Now, there are several IRAs out there, but they can really be broken down into two categories: pay taxes later or pay taxes now. And what's the benefit to each of those? If I choose to pay taxes later, that is typically a traditional IRA for most people. For most people, I can make a tax-deductible contribution to that traditional IRA, which means that if I put $6,000 in that traditional IRA, I can subtract $6,000 off my income, assuming I don't make too much money. And that helps lower my tax burden right now. And so if I'm a person who at the end of the year, when I file my taxes, I typically owe the federal government a decent amount of money, I might consider making a deductible contribution to a traditional IRA to lower my current tax burden. Now, the caveat to that is I can lower my current tax burden right now. The money can grow without being taxed, but after age 59 and a half, when the account is designed to be accessed anytime after age 59 and a half, I can make a withdrawal from that account with no penalty. However, I will owe taxes at that time. If you are a person who when you file your taxes, you really don't owe any taxes or you get a refund back, there's really no need for you to take a tax deduction. So what is a more powerful option is you to make a non-deductible contribution to a Roth IRA. The Roth IRA is funded with money that has already been taxed, but then going forward, it is never taxed again. It grows without being taxed, and in retirement, after the age of 59 and a half, you can withdraw the entire account tax-free. If you are an investor that has multiple decades to retirement, that Roth IRA is a powerful, powerful tool. Get on moneychimp.com. There's a compounding calculator on there, and you can take a look at that. And the beautiful thing about the Roth IRA is that number that you see, what you end up with, once you have your assumptions with your growth rate, that money is all yours. You don't have any partners in it. The federal government's not a partner. The state government's not a partner. That is 100% your money. All right, so to recap here, 3 types of investment accounts. And which one is right all depends on the answer to this question. When will I need the money? If it's prior to retirement, I want a non-qualified account. If it's after retirement, it's typically a retirement account, which typically for most people is a traditional IRA or a Roth IRA. The Roth IRA is the tax-free. I'm not taking the tax deduction now, but going forward, it's forever tax-free. The traditional IRA allows me to take a tax deduction to help my current situation with taxes. If you have any questions, reach out to us. You can find us at crosbyadvisory.com. Thanks for listening.